Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I get a lot of requests for him for his analysis about gold stocks. He's been a fund manager covering gold stocks, commodities, and value investing for many decades. He also has a paid newsletter. Adrian Day, thank you for joining me again.
Well, thank you, Jason, for asking me.
So, Adrian, we're recording this interview on Monday, September 23rd, 2024. The gold price has held up very, very well considering all the negativity out there with a lot of Wall Street saying gold's run is over now that the Fed's going to be lowering rates. It's hilarious, the Wall Street narrative. If the Fed's raising rates or if the Fed's cutting rates, it's supposedly bearish for gold.
Right.
So I want to get your thoughts on the profit margins for a lot of these gold miners, for the senior and the mid-tier ones. Do you think that they have good free cash flow right now in profit margins?
Well, yeah, part of the problem with gold stocks for a little while now, of course, has been that they really haven't had much in the way of free cash flow, let alone earnings. But the last, really the last 3 quarters, 4 quarters, that's really changed dramatically. And January was a very good month for free cash flow for most of the companies. And then, of course, the second quarter with gold higher by about $250 average during the quarter. Pretty much all of the companies had strong free cash flow. And I'm expecting a third strong back-to-back quarter. You look at this quarter, so far gold, I'm eyeballing this, excuse me, I don't have the exact number, I'm just eyeballing it on a chart. But it looks to me as though gold is averaging around $160 an ounce higher this quarter than in the second quarter. So, if we get 3 quarters back to back of strong and increasing free cash flow, I've got to think that some people on Wall Street are going to start to pay attention. Because, not only are we seeing strong cash flows, but the cash flow multiples for the companies are still pretty low. My favorite example would be Agnico, which, of course, Agnico is the third largest gold mining company in the world. The stock's done remarkably well this year. But I pick Agnico not only because it's a large one, but because there's no particular there's no particular hairs on that dog, as they say. There's nothing that people can point to and say, oh, well, that's why it's cheap. It's not Newmont that's just done a merger and has to consolidate. It's not Barrick, which has a lot of political risk. Agnico has a very low political risk. It has strong mines. It has a good pipeline of future projects, strong cash flow, etc. And yet you look at Agnico, and it's certainly not selling at its lowest price to free cash flow. But if you look back over its 40-year history, it is well at the very lowest end, like in the lowest 15 percentile of its price to free cash flow. And normally, as you know, when the price of gold moves up, then the multiples start to expand. Not only do you get better cash flow, but the multiples actually start to expand. And we're just not seeing that now. So, yeah, I think a third back-to-back quarter will start to get some people's attention.
Let me add to your points there. Stanley Druckenmiller, I think, is the only big name regular macro guy, I think, that's been accumulating gold stocks the last 4 to 6 months, and it's just Newmont Mining and Barrick Gold. So we haven't seen any major hedge fund managers start to accumulate those gold stocks, like you said, and that will then cause the re-rating when more value investors or macro people come in. Regular generalist hedge fund managers start to buy that. Did you see the chart though from hedge fund manager Tavi Costa, who covers commodities? He was saying that the gold stocks actually have the most free cash flow growth, I think, in the last 9 to 12 months of any industry.
I did not see that, but no, that's absolutely what I would believe. Yeah. And it's been a bit of a stealth rally. You look at the gold stocks. The gold stocks have actually outperformed the S&P over the last, year to date, over the last 12 months. And yet people just aren't paying attention to it. We're still getting outflows. Well, we've started to get inflows into the gold ETFs in the last, really just this month. So it really is a stealth rally, no question about that. But, I think there's fundamental reasons for that. If you look at, everybody for the last year has been saying, well, gold's been going up. Why aren't the gold stocks moving up? And first of all, as I just said, I mean, I disagree with the basis of that question. The gold stocks have been going up. It's just that, maybe the amalgamated moose pasture hasn't been going up. And that's what, that's what the people complaining about the gold stocks own. The second point I'd make, frankly, is that, I'm a gold bug, so I don't say this in any derogatory manner, but gold bugs are a peculiar breed. We always are disappointed. We always want more than gold and gold stocks offer. So, the gold stocks have in fact performed, the senior gold stocks have performed quite well this year, the last 12 months. But there is a reason why we have not seen the normal kind of leverage to gold that we normally get. And the reason is quite simple. If you look back at the last 2 years, the reason that gold has gone up so much is totally disconnected from the macroeconomic environment. It's gone up because central banks are buying gold, and they're not buying it because US interest rates are moving down or anything like that. We know why they're buying. Chinese investors are the second largest group of demand for gold bullion over the last, certainly this year. And again, they're buying because of circumstances that are peculiar to China. And so and the macroeconomic environment has been, broadly speaking, negative for gold. We've had high interest rates, we've had apparently low and declining inflation and therefore high real interest rates. We've had, again, apparently strong economy. And the dollar, although the dollar has obviously come off from the peak, it's not exactly incredibly weak at the moment. And so the macroeconomic environment has not actually been conducive to gold. But that's why the gold stocks have not done as well as maybe people would expect them to do when gold is moving as high as it is. That's beginning to change, clearly, with the Federal Reserve moving, cutting rates. The economy in the US are clearly slowing. I think nobody's talking about no landing anymore. Some people are still talking about a soft landing. But I think a lot of people are beginning to realize that the economy is a lot weaker than the headline statistics would suggest. So a weaker economy, a slowing economy, cutting interest rates, while inflation is still not, inflation is still not being quashed. That is the ideal environment for gold. And by gold, I mean gold assets generally, for gold to flourish. And so that's why in the last few weeks, we're starting to see inflows into the gold equity ETFs. We're starting to see inflows into, gold mutual funds, etc. In my mind, this is only the beginning, though. This is only the beginning.
I agree.
Yeah.
We're going to expect a re-rating. So there's going to be more demand for gold stocks, especially the most well-run companies first. With that free cash flow, I mean, we're well above $500 an ounce free cash flow margins. I mean, a lot of these, even higher cost gold miners, the costs are between $1,800 an ounce, maybe $1,700 an ounce, and $2,000 an ounce. That's still pretty good free cash flow margins. And that's not even counting the lower cost producers like Agnico Eagle or Lundin Gold. They have very, very robust free cash flow margins. Where do you think this free cash flow is going to go? Is it going to go into mergers and acquisitions? Are they going to spend it on exploration drilling? Where do you think it's going to go?
Yeah, good question. And that was actually one of the main themes at the big Denver Gold Conference last week. At the moment, there's still a fairly good, spending fiscal discipline among the major gold mining companies. I suspect that'll change at some point. But at the moment, it still exists. Most of the companies that I spoke to said growth of the business, enhancing the business is the number one use of free cash flow. That doesn't necessarily mean mergers and acquisitions. We've seen some big ones recently. It could just mean brownfields exploration. It could mean mine expansions, etc. And we've seen a lot of that in this year. Beyond that, most companies seem to be putting dividends, either instituting a dividend policy for the smaller ones, or I had several small companies say to me they were thinking of instituting a dividend policy or enhancing their dividend. That definitely seemed to be a higher priority than buying back stock. Oh, and I'm sorry, the other one I forgot. After enhancing growth, enhancing projects and growth of the business, reinvesting in the business, the number one priority for most companies was continuing to pay down debt. And that's interesting because, debt levels of most of the producers are actually quite good right now, given that mining is a capital intensive industry. And so, debt is just part of a fiscal framework, if you like. Right now, most of the senior companies have very, very low debt. In fact, the XAU in aggregate is cash positive on the balance sheet.
Is that the first time ever, or for most?
No, but that includes the royalty companies, of course.
Oh yeah.
But even if you look at, let's say, Barrick, that's cash cash positive or cash neutral, I would say, on the balance sheet. And the same goes for several of the major miners. So they're going to continue to pay down debt. Some companies like B2, for example, or Fortuna have taken on meaningful amounts of debt in the last couple of years for new mines, mine acquisitions, mine builds, mine expansions. And those companies have traditionally run with very, very lean balance sheets. So I think they're going to continue, they've said they're going to continue to pay down debt. So first of all is, putting money back into the business. The second one is paying down debt. And after that, most companies seem to favor dividends as opposed to share buybacks.
And we're also seeing tens of millions of dollars into exploration drilling over the last, I would say, 9 to 12 months, that in the past, some of these projects, Adrian, they haven't been drilled in 5 or 10 years, and they're starting to see tens of millions of dollars of drilling again.
No, absolutely. And that's what I meant by, putting money into the business. No, certainly you're seeing that a lot. It's brownfields exploration. It's also, as you say, projects that haven't been drilled for a while being drilled, and there's I won't say a large amount, but there's some, greenfields exploration being undertaken by not so much the seniors, but certainly by the second tier companies. And that's a very, very positive sign for this business because, frankly, not just the gold business, but resources generally, they just haven't put enough money back into the business. And if you don't, as we know, mines are depleting assets. So, in order for the business just to stay where it is, you have got to continue to explore and continue to discover.
Now, I want to ask you about some of the mergers that have occurred recently. The most recent one was Anglo Gold Ashanti. They made an acquisition, I think, a low-cost mine, producing mine in Egypt. Also, in the last couple of months, you had Goldfields buy the last remaining stake for Osisko Mining, the Windfall project in Quebec. Are those tier one assets? Do you think that the senior and mid-tier producing gold miners, are they looking for the absolute best assets to buy first, like these tier one assets that are high-grade, low-cost mines that are past the feasibility study stage and ready to go into production in the next 2 or 3 years?
Yeah, it's definitely developmental assets that are the main thing that companies are looking for at the moment. And it's interesting that both of those two that you mentioned, were acquired at reasonable premiums. So that's something, again, that we haven't seen in the business for a little while, are these, reasonable premiums. In the case of Goldfields, I think it was a 38% premium over the 30-day VWAP. And that's particularly significant, I think, given that Goldfields already own 50% of a project. Now, there was apparently another company looking to buy the other 50%. But when you already own 50% of an asset, you normally don't have to pay a 36% premium to acquire the rest. So I think we're going to see more mergers and acquisitions. We're going to continue to see these kind of premiums, notwithstanding what Barrick's Mark Bristow says about high premium acquisitions. The question I would raise now, I think anytime you see a few acquisitions like this, and of course there's been more, everybody gets terribly excited about what's next. Companies can only absorb so much at any one time. And so Anglo has done this. So Anglo Goldfields have made these acquisitions. Agnico has plenty on its plate at the moment in terms of the underground malartic. Newmont, of course, made a huge acquisition merger with Newcrest last year, and that is in the process of actually selling off some of the assets. Pan American is still selling off assets for Yamana. So, I think so. You've got a lot of properties coming onto the market that companies want to get rid of after these big mergers. That's standard. That's typical. And so I think that will have a little bit of a, that'll deflect a little bit from, new acquisitions in the near term, just in the near term.
Do you think that the mid-tier gold miners, like a Lundin Gold that has one great mine, the Fruta del Norte mine with a low cost and high free cash flow, do you think that they're going to be more aggressive, maybe and go and look to diversify and buy maybe an asset, the next acquisition target outside of Ecuador? Do you think we're going to see the mid-tier producing gold miners with better free cash flow start to be more aggressive here?
Yeah, I think that's absolutely true, especially if they have either a single asset or their largest asset is in a, one country, which we know how the political risk in these countries can change from time to time. So Lundin would be a good example. I think once B2 has its Goose Bay up and running, it's in Nunavut. Once that's up and running, which won't be for another, 18 months yet, they will probably look to add another leg to their stool. When you're in the Arctic and in Mali, maybe you want something a little less risky. And I'm not suggesting Nunavut is politically risky, but it's the Arctic, and that's a risky risky area, let's say, geographically. So yeah, I think we're definitely going to see that, and one can think of lots of examples where that could happen.
Well, Alamos Gold maybe would have been in the market for another acquisition, but they got Mangino basically fell into their lap with the problems with Argonaut Gold.
Yeah, and I think there's always issues like that. That's still a merger and acquisition, of course, but it might deflect a company from going after something bigger or more aggressive. And again, there's several examples I can think of what we might call obvious mergers, properties that are,
next to each other or close or very close to each other,
right next door to a major development by a major company, where the major company actually wants the land for either declines or for infrastructure. And there are several of those around the world. I hesitate to mention those because, you don't want people rushing out buying things when it may be another year or more before something happens. one thing I always say to people is, remember, if there's one obvious buyer for a particular company, then that means for the target company, there may only be one potential acquirer. So it kind of works both ways. If you've only got one potential acquirer, your price is not normally as high as if it's something that there's going to be a lot of competition for.
That's an excellent point. So your point is that if, let's say, a major, senior, or mid-tier gold producer is right next door, then the other senior or mid-tiers might not want to bid on it. So then there's less bidders for the asset than for the junior.
Exactly. And it also means that the senior can afford just to wait. They don't need to.
Or play games like what Rio Tinto did with Oyu Tolgoi there with Port Turquoise Hill Resources there, how like the funding was slow played. I mean, that's happened in the past too with Fresnillo and Mag Silver. I mean, there's the larger miners can play some games there and delay some of the development of some of these assets. The average retail investor doesn't understand some of the games. If a company wants to acquire, one of these great junior projects, they can play some games with it to kind of knock the stock price down or delay the funding of a development of a mine so the share price gets weak and then come in with a lower stink bid takeover bid.
Sure, absolutely. And of course, depending on if they have a joint venture agreement or something like that, the opposite can happen. If a junior company is obligated to pay 30% of the capital cost, the senior company can come in with a big expenditure program that the junior has to be diluted down because it can't afford it. So yeah, I mean, those things go on. I hate to use the word game because if you make an agreement with someone, you better go in with your eyes open, knowing what all the possibilities are. But yeah.
If you have enough cash, though, I mean, and you have good enough lawyers, like what's in the contract, as you know, like things can be fast and loose with that. As long as you have a lot more money than the other party in the contract and you have good lawyers. I mean, unfortunately, this is the world we live in.
Sure.
Now, I want to ask you about Franco-Nevada. So the shares are rallying a little bit. It's up to like $126 a share when we're recording this interview. Do you think that all the bad news is finally priced in with Cobre Panama and that we're seeing light at the end of the tunnel for a potential resolution? Or do you think that the shares are not pricing in future growth or a reasonable valuation?
No, I think that the negative news is certainly priced in. And I would also say that, last month when they reported their earnings, as you know, they reported the second quarter earnings. They reported shortfalls, misses from two of their larger royalty assets. One of which was already known to the market or should have been known to the market, but so the company missed their earnings because of shortfalls of two of their assets, and the stock actually had its largest percentage decline in its history, larger even than when Cobre Panama was suspended. Now, that to me is a reflection of incredibly negative sentiment. And I think following on from Cobre Panama, perhaps it was just one thing too much for some of the generalists that own it and aren't so familiar with the mining business. But it was particularly stupid when the company on the conference call, in the middle of August, actually said, well, this was June, and now both of the problems have been fixed. Both of the mines are running, back to their normal operations. And we, Franco-Nevada, expect to end the year. We maintain our guidance and expect to end the year within our guidance, albeit at the lower end of the guidance. So for the stock to collapse the way it did, I think was just a reflection of bad sentiment. So yeah, I think the negative news is out. You can always have something else happen, of course. I don't know what it might be, but anytime a miner or a royalty company has a large number of assets, you always have the risk that something somewhere will go wrong. That's the nature of mining, as you know. But I think the bad news, certainly on Cobre Panama, is already reflected in the stock. The company's written it off completely, as you know, and so at this point, there can only be upside from Cobre Panama. I suspect that Cobre Panama will I'm pretty certain that Cobre Panama, the mine, will at some point resume operations. Whether it will be with First Quantum or not, is perhaps less certain. First Quantum may decide to sell the mine to make it easier for the government to. It may just be politically difficult to get First Quantum mine in there again. I'm not saying that I know anything specific. I'm just saying that the mine will probably resume, and First Quantum may or may not be the operator. The stream that Franco owns would go with the mine if it were a friendly sale. So if First Quantum decided to sell the operation to Barrick, let's say, the stream would go with it. If the mine was simply confiscated, which I don't think will happen, then the stream wouldn't go along with it, and we'd be left with arbitration, which is a less satisfactory solution. So, but anyway, I think Franco at this point is only upside for Franco from Cobre Panama. I do think though that Franco being at the time before Cobre Panama the largest of the royalty companies and the longest established, had a very, very high percentage of his stock ownership was from generalist investors. And generalist investors, in the main, are not as familiar with the mining industry as obviously specialists. So they're less comfortable with these huge with these problems that we both know, and all your listeners know. They happen from time to time. And so Franco had sold itself, and I don't mean this in a negative way, but it had presented itself, let's put it that way, to generalists as the safe gold investment that pays a dividend. And of course, Cobre Panama showed that even royalty companies, though they don't have to contribute to, unexpected capital costs or anything, they're still in the mining business. They're still subject to risks. And that was a perfect example. So I think the generalist investors became a little, this is my own suspicion, they became a little gun shy of any kind of gold mining investment, including gold royalty investments, when that happened to Cobre Panama. And it may take a little while for them to come back.
Yeah, I agree. But there are some specific issues. I mean, I don't know if you saw an interview with Randy Smallwood from Wheaton Precious Metals. He said that they were actually offered the gold stream contract first with First Quantum for Cobre Panama. And he said there wasn't enough legal protections in the deal. And he said they walked away from the deal. And then Franco took the deal, even though there wasn't the normal legal protections in the streaming contract that there normally are for pretty much every other standard for certain legal protections.
Well, yeah. How can I put this politely? I think that's Randy's interpretation. I mean, Wheaton has not always, but certainly in recent years, Wheaton has always insisted on getting a corporate guarantee behind its streams. So, if the mine goes bankrupt, then the company is responsible for delivering ounces from its other mines.
Okay, I see. So
and
the normal
that is not necessarily true. That's something that Wheaton does, and it protects them, of course. It's a very strong protection. I don't think that's necessarily the standard of all streams in the business. And in the case of First Quantum, given that Cobre Panama was the largest mine, having a corporate guarantee wouldn't, even if the company was prepared to give it, wouldn't necessarily have solved, helped you out in a situation like this, where the whole mine shuts down.
Okay, I see. Thank you for that clarification. Yeah, it's just interesting hearing like them squabble over the details because it's a bad deal, and then people are Wheaton Precious Metals didn't even do the deal, and then so he's commenting on it. It's just weird to hear that in public. But it looks
Well,
like
I think what he's trying to get across, and I do respect Randy Smallwood. I don't want to give the opposite impression. I think what he's trying to do is saying, look, we Wheaton, we're prepared to pass on deals if we don't have adequate protection, and that's a fair point to make.
I think we're starting to see the new trend. We're going to start to see some of these senior and mid-tier royalty and streaming companies. They're going to start to do these syndication deals on copper mines, though. We're starting to see announcements of like 500 million in guarantees or more for potential syndication deals now.
I think I must say, I followed the gold mining royalty business for a long time. I was an early investor in Franco in the first incarnation of Franco back in 1984. So it goes back a long time. And I've always wondered why there weren't more syndications. If you look at other businesses, I follow, for example, the business development companies, the companies in the US that lend money to small businesses. And syndications are just a standard part of that business. And it's really only been in the last few years that you've started to see syndications in the gold mining business. I think part of that was because it wasn't really necessary because the big companies like Franco and Wheaton, had strong enough balance sheets where they could do any deal themselves if they wanted to. And I think also in our business, there's for a long time just been this sort of jealousy. Everyone's trying to outdo the other person rather than move the industry ahead. But we've seen several syndications now. The most recent one, I think, was the Franco and Cisco one.
For Sol Gold, right, in Ecuador.
Yeah. And then, of course, we had it on Caserones. So I think we're going to, with Franco and EMX, I think we're going to start to see a lot more of that, frankly. It just makes sense. It just makes absolute sense. It's a way of spreading the risk. It's a way for smaller companies to get a piece of a deal that they couldn't afford on their own without taking on undue, concentration. So I just think it makes absolute sense.
Yeah,
and it makes sense, as you say, for these huge copper development projects, where really only Franco and Wheaton are the only two that are really players individually. But sorry.
Well, also you have the mid-tier royalty and streaming companies, their portfolios are starting to mature now and cash flow more. So like Triple Flag and Osisko Gold Mining and Sandstorm Gold, the royalties and streams that they bought years ago, they're starting to cash flow more and there's more growth there. So they're going to be able to buy larger and larger assets and do these syndication deals going forward with more of the larger players.
No, absolutely. Absolutely. I think we're going to continue to see more of that. And I personally think that's only a good thing.
Yeah, I totally agree. I think for those copper mines, the capital expenditure for a medium-sized one is $1 billion or more. I mean, does Franco or Wheaton really want to take on all that risk, or do they want to split it 50-50 or 60-40 with another royalty and streaming company? It just makes so much sense to maybe split it into halves or thirds for a stream.
Yeah, no, absolutely. And I think we're going to see that. That's particularly on the streams or royalties that are created. On the legacy royalties, sometimes they will go through a process, they'll be put up for auction. And part of the condition is that the companies cannot syndicate. And that, of course, is because the seller, the vendor, thinks that if we allow companies to syndicate, they'll all get together and, we won't get as good a price as if they're all outbidding each other.
By a legacy royalty, do you mean like on a producing mine? So the royalty or stream already exists and someone's just auctioning it off for the highest bid?
Correct. Yeah.
Okay. I wanted to make sure there was a clarification there for our listeners.
No. Thank you.
Okay, last question here. I want to ask you about origin royalty because I get a lot of questions about that. So, yeah, okay. So for listeners out there, Anglo Gold Ashanti is spending $70 million on drilling for the property. There's two deposits next to each other in Nevada. I think it's the largest discovery for the Merlin deposit and the Silicon deposit. What type of royalty does Origin have? And have they actually said publicly that they want to sell it or sell the company, sell the royalty or sell the company?
Yeah, so good questions. Yeah, at the moment, what Anglo now calls the expanded silicon, which is Silicon and Merlin, which are not quite adjacent, but almost adjacent, and with additional drilling may in fact turn into one big deposit. But they're calling it the expanded silicon. That's currently 13.2 million ounces, which is astonishing when you think that 2 years ago was really when they started to when Anglo started to realize that there was something there. Even a year ago, it was only 6 million ounces. So we're at 13.2 million ounces right now. Drilling, as you say, is continuing on a very aggressive manner. There's about 25 drill holes to the west of Merlin that have not been announced yet, but Anglo CEO Alberto Calderon said the results were exciting. That was back in March. If Anglo has exciting results and then puts in another 20 holes in 6 months, I would venture a guess, but they're getting something pretty good. They're not just doing it for the fun of it. They've done some holes to the north. They drilled for water and got mineralization. So yeah, I think there's a lot. I think this thing is going to get much bigger. Origin has a 1% royalty on an area surrounding expanded silicon, and that will include some other targets, drill targets, but have not been announced yet. Another company, incidentally, Altius Minerals, which is a diversified royalty company, really has very little in the way of gold. That has a 1.5% royalty on the entire district, but the area of interest is being contested at the moment in arbitration. So we don't really know the extent of that royalty, but in any event, it's 1.5%, and the 1.5% on Silicon-Merlin is not contested.
So it sounds kind of messy because of how big this discovery is. Now people are suing each other in court because they realize that this is a huge discovery. It's looking like this is going to be a tier one discovery, even though we don't have
absolutely. Yeah. I mean, you've got, in terms of size, in terms of jurisdiction, and in terms of the operator, yeah, this is a tier one discovery all around. And so the major, you can guess that all of the major royalty companies are interested in this. Interestingly, Randy Smallwood said to me that they are not really pursuing it, partly because they don't think they're going to win. So if you don't think you're going to win because you're not prepared to pay up for something, why waste your time, going into it? But certainly we know the Franco, Royal, and we know, some of the smaller companies as well. By smaller, I mean the mid-tiers are also pursuing this. It's a kind of royalty that only comes up once in a generation.
So you really think this is going to be up there with the Great Bear royalty, the one that Royal Gold bought for 100?
Absolutely. No question in my mind. This is not as big. We still don't know how big this is going to get. And I think just the Silicon-Merlin is going to get probably to 20 million or more. And the expanded district, and again, that's under arbitration, is going to be meaningfully larger than that. Now, both Origin and Altius have said publicly that they are looking to sell it. But I think it's true to say that neither one is committed to sell it. It's very much dependent upon the kind of bids that they get. If they don't get bids that they consider high enough, I don't think either company will want to sell it. The interesting thing is, if you look at the large ones in particular, Franco and Wheaton have both said many, many times publicly that they are, to use Paul Brink of Franco's words, we are prepared to pay a full and fair price for what is currently known, and then I'm now paraphrasing, but the company wants the upside, and that's sort of a policy of Wheaton as well as of Franco. Now, the problem with a deposit like expanded silicon that is growing so dramatically, and everybody believes is going, we haven't reached the extent of it yet. But difficulty in saying we'll pay you for what is known is that, the sellers, Origin and Altius, believe that have reasonable reason to believe, it's not blue sky, but there is a lot more upside. And so, they want to be paid for more than what has been proven at the moment.
Is there a pre-feasibility study on those deposits yet, or that coming soon?
No. Anglo is undertaking a feasibility on Merlin at the moment, but it won't be ready probably until the middle to end of next year. And it's ironic, but part of the reason that they haven't done this yet, and it's been delayed and it's taking longer, is because they keep adding new ounces. So when you keep
it's a good problem. It's a good problem.
It's a good problem. You want to incorporate it in your pre-feasibility study, but there isn't one at the moment. No, there is what Anglo did put out, what they call a technical study on Merlin, that sort of condensed the mining into just 7 years with 1 million ounces 2 years of pre-strip, and then the first full year of mining of 1 million ounces. The second full year of mining, they showed 1.8 million ounces, which is just astonishing. Just astonishing. There's only one mine in the entire world, but on a regular basis produces more than 1.8 million a year. Now that was a technical study, so a long way from a feasibility, but nonetheless, an indication of what they're thinking.
Exactly. So that's the point that Adrian's making, is that this is a great asset, but it's still many years away from building the mine and going into production because of all the steps required. So you have to have a pre-feasibility study, and then you have to do more infill drilling, then you have to come up with a bankable feasibility study, and then you have to raise the funds, and you have to start construction and build the mine. Could be looking at 7 to 10 years from construction.
Well, yeah, interesting, because again, Silicon-Merlin is part of a bigger district. So one deposit in that district, oh my gosh, the names escape me right now.
Is it near Carlin Trend with Newmont and Barrick? Is it close?
No, this is on the Walker Lane Trend. It's not the Carlin Trend. But Anglo acquired deposit. Well, they first of all bought Corvus, and then they also bought a deposit from Coeur to try and consolidate this whole region. Their plans at the moment are to start mining at one of the northern deposits, which is a lower grade and a smaller deposit, but already has some of its permits, to start mining there. And they're looking at doing that as early as 2026. Early in the year, they were talking about Silicon being 2029 or 30, but I think you're right. That's going to be pushed back. They're not going to start, building facilities and getting permits until they have a better idea of how big that deposit is. So I think it may well be 32, 33 before that comes into production.
Yeah, so like Altius and Origin, they want a high valuation for something that's over 5 years away from cash flow. So that's why the larger royalty companies might not justify bidding a much higher valuation for that royalty asset, even though it's a good asset. You have the same type of criticism, 18 months ago from Royal Gold when they bid, $150 million in cash for the Great Bear royalty. But I think they just finished the pre-feasibility study recently, and it's looking like if you put out the cash flow projections for Kinross, they're building out Great Bear. It looks like Royal Gold got a pretty good valuation there for the future value with the mine plan.
Absolutely. And I just want to make sure that I clarify. I'm not saying there is an argument between, let's say, Franco and Origin as to how much it should be worth. I was saying, just generally speaking, conceptually, Franco likes to pay for what is known and keep the upside. In this particular case, they're going to have to pay for some of the upside.
Yeah, and we're not even at a feasibility pre-feasibility. So pre-feasibility would give us a lot more information. We're seeing that now with Great Bear. So
sure.
And now, like, I guess a lot less people are going to be criticizing Royal Gold for paying 150 million in cash. I know at the time they were heavily criticized. Like, you have no idea, it could be a lot less. I mean, now, like, it's looking like compared to the valuations for a lot of other royalties and streams available, like Royal Gold got a pretty good deal.
Well, absolutely. And of course, they also were criticized for overpaying for that second Cortez royalty that they bought. You know, Cortez is the foundation. The first Cortez was the foundation of Royal Gold. And when the second royalty came up, they were accused of overpaying, and people were saying, well, it was a kind of emotional purchase because, you know, that was the foundation of their company. But, you know, I remember I had a one-on-one meeting a year ago with the CEO, Bill Heisenbuttel. And he made the point to me. He said, look, these things won't start producing till 32 or 33. Do you think if you come back to me in 10 years' time, he said, I have no idea what your projections for a price of gold are, but if you come back to me in 10 years' time, do you think at that point these two will look, Great Bear and Cortez, will look as though they were good purchases? And he said, we think that in 10 years' time, we absolutely will want to own these two royalties. And so, I mean, it's a different policy than Franco and Wheaton, but I think it's certainly what his argument is perfectly logical. There's only so many, and that's the point about silicon. There's only so many of these really big deposits with royalties in good jurisdictions. And, you know, if you're a senior royalty company, you want to make sure you own some of them.
Yeah, especially with the mess that Franco just had with Cobre Panama, you'd think that they'd want to focus on what the US and Canada or Australia safer jurisdictions now.
Right, right.
Well, Adrian, I really enjoyed our discussion today. Great insights there in the royalty industry and that one particular royalty. I mean, that sounds like the major discovery right now.
Absolutely. Absolutely.
If my listeners want to check out your newsletter or your fund, how do they do so?
Well, the best way to go is just adrianday.com, and then that'll point you to either the newsletter or the money management.